Welcome to this explainer. If you think about it, a company's financial statement is kind of like its own highly detailed financial diary. Every single sale, every weird unexpected loss, every major strategic shift, it's all recorded right there in those pages. But unlike a personal diary where you can just jot things down however you feel like, a corporate financial diary has to be understood by investors, analysts, and regulators all over the world. We need to be absolutely sure that when we're reading these pages, we're getting the true story. So how do we guarantee that everyone is writing and reading these diaries the exact same way?
And that brings us to our core problem. How do we actually compare apples to apples in finance? Look, if one company records a massive one-time loss as just a regular Tuesday, and another company completely hides a huge operational failure behind a so-called rare event, comparing their financial diaries would be absolute chaos. Trying to compare one company's performance to another, or even just looking at one company year over year would be impossible. Without uniform rules, the numbers literally lose their meaning, and transparency just goes completely out the window.
Enter our solution, Accounting Standard 5, or AS5 for short. Think of AS5 as the ultimate grammar rulebook for a company's financial diary. It strictly prescribes the classification and disclosure of specific items in the statement of profit and loss. Its entire objective, the whole reason it exists, is to ensure that all enterprises prepare and present their statements on a totally uniform basis. By forcing everyone to use the exact same financial grammar, AS5 drastically enhances the comparability of those financial statements over time and across different businesses.
Okay, let's dive into this. Here's our playbook for today. 1. Unpacking profit and loss. 2. Fixing prior period errors. 3. Updating accounting estimates. And 4. Changing accounting policies.
All right, Section 1. Unpacking profit and loss, the core activities.
So, the standard requires that all items of income and expense recognized in a period have to be included in the net profit or loss. But, and this is a big but, AS5 forces companies to break that bottom line down into specific components right on the face of the statement. We've got profit or loss from ordinary activities, extraordinary items, and what we usually call exceptional items, which are basically ordinary items that are just so large or unique that they demand special attention. This breakdown is absolutely crucial. Why? Because we don't want readers getting misled into thinking some lucky one-off windfall is going to happen every single year.
Let's actually look at the juxtaposition between ordinary and extraordinary here. Ordinary activities are exactly what they sound like. Stuff done as part of the normal, everyday business. Think selling merchandise or taking a loss on some unsold inventory at the end of the season. Extraordinary items, on the other hand, pop up from events or transactions that are clearly distinct from those ordinary activities. They are definitely not expected to happen frequently or regularly. An example right from the source material would be the attachment of property of the enterprise. That's a highly distinct, rare event.
Now here's a really fascinating nuance from the rulebook. You might think a massive natural disaster is always extraordinary, right? And sure, for most enterprises, losses from an earthquake absolutely qualify as an extraordinary item. But what if you're an insurance company that literally insures against those kinds of risks? Well, for that insurance enterprise, paying out claims to policyholders because of an earthquake does not qualify as an extraordinary item. It all depends on the nature of the event in relation to the business you normally carry on, rather than just how often the event itself happens.
Then we've got this sort of hybrid category. Sometimes an item falls perfectly squarely within ordinary activities, but its size, its nature, or its incidence is just so huge that disclosing it is super relevant to explaining how the enterprise actually performed. The source highlights a few circumstances that trigger this separate disclosure. We're talking about the write-down of inventories to net realizable value, major restructuring costs, disposals of property, plant, and equipment or long-term investments, legislative changes with retrospective application, and major litigation settlements. Basically, they're ordinary, but they are exceptionally noteworthy.
Let's move on to Section 2. Fixing prior period errors, correcting the past.
This brings us to what we call prior period items. AS5 defines these really clearly. They are income or expenses arising in the current period as a direct result of errors or omissions in the preparation of financial statements from one or more prior periods. Now, these aren't intentional strategic shifts. They happen because of math mistakes, messing up the application of accounting policies, misinterpreting facts, or just plain old oversight. And just like those extraordinary items, their nature and the amount have to be separately disclosed so you can actually see their impact on the current profit or loss.
And this brilliantly illustrates the difference between an error and a conscious choice, using an awesome example straight from the source material. Imagine a company, let's call them People Ltd., has a $50,000 outstanding balance from 5 years ago. They decide to write it off as income
and try to classify it as a prior period item, simply because the balance originated in the past. But AS5 says, absolutely not. Writing off an old debt based on your current company practice is a current year decision. It's not a past error, so it doesn't qualify as a prior period item at all.
All right, Section 3, Updating Accounting Estimates, Adjusting to Reality.
The standard gives us a really fantastic guiding principle here. It states, quote, accounting estimates by their nature are approximations that may need revision as additional information becomes known. By definition, estimating is just not an exact science. When a company revises an estimate because they have new experience or something new developed, that revision doesn't suddenly make the adjustment a prior period error or an extraordinary item. Not at all. It's simply the financial diary adjusting to a new reality.
Let's move to and see how this builds with a timeline example. Let's say a company buys a machine for 10 lakhs, and they estimate it has a useful life of 10 years. So they charge 10% depreciation, that's 1 lakh, every single year. After 5 years, the carrying amount of the machine is 5 lakhs. But suddenly, management realizes some new info. The machine is actually only going to work for another 2 years, not 5. How do they handle that? Well, they take that remaining 5 lakhs and depreciate it by 2.5 lakhs each year for the next 2 years. This is a totally classic example of a change in an accounting estimate.
Let's heavily contrast that directly to make sure we keep these concepts perfectly separated in our minds. A change in estimate is realizing the machine breaks down sooner. You're adjusting your future behavior based on new facts. But suppose there was no change in the machine's useful life. Instead, back in year 5, management mistakenly calculated the 10% depreciation on 6 lakhs instead of the original 10 lakhs. So they charged 60,000 instead of 1 lakh. That 40,000 difference? That isn't a revised estimate, it's a straight-up math error. That would be a prior period error that absolutely requires a correction of the past. Now, when an estimate does change, AS5 dictates exactly how it impacts the timeline of our financial diary. The effects gets included in the net profit or loss in the period of the change if it only affects that one period. So, for example, a change in the estimate of bad debts is just recognized immediately. However, if it affects both the current and future periods, like our machine depreciation example we just talked about, then the impact is spread across the current period and each future period during the remaining useful life of that asset.
Which brings us to Section 4, Changing Accounting Policies, the Strict Rulebook.
So, the crucial point here is that a company cannot just wake up one day and decide to change its fundamental accounting policies on a whim, maybe to make its numbers look a bit better. According to the standard, policies can only be changed under 3 incredibly strict conditions. First, when adopting a different policy is actually required by statute. Second, for compliance with a new or updated accounting standard. Or third, when it is considered that the change would genuinely result in a more appropriate presentation of the financial statements. And if the change has a material effect, you better believe it must be thoroughly disclosed. But it's equally important to know what does not constitute a change in policy. If a company adopts an accounting policy for events or transactions that are actually different in substance from what happened before, that's not a change in policy. The source gives a really great example of this. Let's say an employer introduces a formal retirement gratuity scheme to replace old, ad hoc, informal ex gratia payments to employees when they retire. Because the underlying substance of the transaction has fundamentally evolved from a random payment to a formal scheme, adopting a new policy for it isn't considered a change in existing policy under AS5. You're just accounting for a brand newly structured reality.
So, we've unpacked ordinary and extraordinary items, the big difference between math errors and shifting estimates, and those strict guardrails on policy changes. Honestly, it all comes back to transparency. If financial statements are a company's diary, AS5 provides the indispensable grammar rules that keep fiction from creeping into the facts. The next time you sit down to look at a company's profit and loss statement, I want you to look way past the bottom line. Hunt for those extraordinary items, the estimate revisions, and the policy disclosures. Ask yourself, with the grammar rules of AS5 in mind, are you really reading the true story behind the numbers? Keep that investigative lens sharp, and thanks so much for joining me on this explainer.